Richard Calhoun, Creekside Realty, 40 years of serving clients here in Silicon Valley. We're here today to talk about week number 49 in the Silicon Valley area, which includes Santa Clara County and San Mateo County, single-family homes and condos. The green is what I call my root URL. I'm pointing out that starting in 2022, which is not far away, the part after the slash will be abbreviated to REMG in 2022. So for 2021, you spell out market graphs, you abbreviate RE, but it will be all abbreviated starting next year. Let's get into the data. This first slide shows you the supply and demand. The reason there's three lines is I have two for supply. The blue line down here is the total inventory. This is the level of the water in the reservoir, and we're right about 60% of the level that you'd expect it to be. But as you'll see later in the presentation, that is not uniformly distributed among the different types of property. The other supply is the gray line. That's the number of new listings in the past week. You can see it dipped way down for Thanksgiving. Then it came up, and we're between the 2 weeks, call it 30% above the level of inventory coming on the market that you'd expect. But the demand has been above long term. And the normal is the yellow line, and that's the 5-year median 2015 through 2019. So the takeaway is we've been having the red line, the demand line, that's been consistently about 20% above the 5-year median of demand. The gray line, the number of new listings coming on the marketplace, has been mostly right at the inventory of the 5-year median. If someone wanted to argue that basically starting after Labor Day, it's been running about 10% above the 5-year median, I would probably agree with that. Whether that will sustain in the long term or not is hard to tell. But even if the number of new listings coming on the market is 10% above the 5-year median and your demand is 20% above our inventory, the blue line down here is going to continue to shrink. And I don't know how far you can shrink below 60%. This is the ratio between the two. This is the single biggest indicator, days on sold inventory. How quickly would everything on the market sell if no new listings came on the marketplace? It's basically a theoretical measure of the turn of the marketplace. And this, instead of being in percentages and raw count, anytime DUI, days on sold inventory, is below 40, I consider it to be a red hot seller's marketplace. Anytime it's above 80, I tend to call it a ice cold buyer's marketplace. We spend very little time in between in a balanced marketplace, which, theoretically it is where do you expect it to spend the time? Basically, it's only there when we're transitioning. We spend most of our time in a strong seller's marketplace, and that's where we basically have been since at least 2015. And I would actually go back and say we've been there since 2010. And why that far back? That's when prices started to appreciate. Yeah, it was still a balanced marketplace, but it was improving the whole time, moving towards a seller's marketplace. So you were just getting rid of the surplus inventory from 10 through 12. Once you hit 12, you are strongly in a seller's marketplace, and we've been there ever since. Yes, there was fluctuations right when COVID was announced. It went into a buyer's market, but that was very short-lived. So anyway, what you're looking at is the days on sold inventory normally here for the 5 years, which I will point out were 5 great years, 5 seller market years, 15 through 19, is typically up somewhere around 35 DUI. We're right now down here somewhere around 18 days unsold inventory, so significantly faster. This now flips over and looks at what the buyers are sensing, feel they're forced to pay over asking price. The purple line here, the broad purple line, is the most recent data. You can sort of see it's at the top. It's also been bouncing around a lot because the dotted lines up here are the oldest and the dashed lines are the second oldest. So basically the market's been fairly steady for several weeks, going back and forth, not really shifting in one direction or another. The dotted red line out here is the best month ever, and the blue line is the worst month ever. Those are monthly data. Everything else is weeks. And this is simply looking at the sale price to list price ratio of every transaction and plotting it. So basically the purple line, is basically right here. So it's basically saying 25% of the sellers get 15% or more above their asking price. Here is a quick table. It shows you all the key indicators, days on sold inventory, how common is overbidding, the magnitude of overbidding. This magnitude is the average of overbidding because the median would be a more stable index frequently at 100%, so you wouldn't really see changes. But you do have to remember that the average is going to be significantly higher than the median. The median would be potentially more meaningful because that's the midpoint where half the people pay more than that, half pay less. And that it doesn't get skewed by someone paying, 75% over asking price, which happened this past week, nor does it get skewed the other direction when someone only pays 59% of asking price, which also happened. So that gives you a range of the extremes, but I think average, as long as you know what average is, it's a statistical benchmark and it's a valid statistical benchmark. And then over here on the pricing, the middle number is the median, which is how the color is assigned. The bluer the color, the more affordable the area. The redder the color, the higher the price. The number to the left is the lowest 10 percentile home that you would expect to find in that area. The number to the right is the highest home you'd expect to find in that area. So if we go to sort of the low moderate area, which is North Valley, Milpitas, Santa Teresa, Blossom Valley, you can see the ranges from about 1,150,000 to basically 1.8 million, with the median in that area being 1.4. So if someone is trying to buy a single family home in those areas for under $1 million or less, it's pretty much going to be a hard battle to do that. Here is my URLs again, because I'm finished the quick presentation. Again, in 2022, the part after the slash will be being changed to REMG abbreviated. I'm always available by email or phone to talk to someone that needs to know what's going on. And with that, I'll open it up to any questions that anybody has. Not seeing any questions, I will slow down and go into the details. We're now looking at the number of new listings for the past week. And you can see the blue line, which is the raw data. Here, it was basically right on top of the 5-year median, really no problem. And again, if someone wanted to say that starting here, basically week 39, which pretty much corresponds to Labor Day, from there forward, we've been listing more homes than you typically have. I can't argue that. The one exception was Thanksgiving, but if you notice, it was low for 2 weeks in the 5-year median, and that's because Thanksgiving moves around a little bit when you look at how I assign the week number to everything. And so the impact of Thanksgiving is spread over 2 weeks, so it really isn't an impact. So basically, from this point forward, every single week we've listed more homes. But again, that extra listing is not enough to even satisfy the extra demand, which is why the inventory is continuing to go down. Now we look at the total inventory. This is the height of the water in the reservoir. That was the new water coming into the reservoir. This is the level of the reservoir. And you can see that there's a normal cycle going on, and inventory normally comes down at this year. But the key thing is we're below the normal amount and we're consistently below. Right now we're down here somewhere around, and this is the macro data, so we're approaching 750 listings where you'd expect to be north of 1,250. So, you're roughly 50%. Data says we're closer to 60%. Some areas like Santa Clara County single family homes, you'll see you only have 40% of the inventory that you expect to have. So anyway, that's just total inventory that's available. This is the number of new offers being accepted. And here you can see consistently it's been above, except again with holidays. But in the 5-year median, this would have been Memorial Day spread over 2 weeks, July 4th spread over 2 weeks, Labor Day spread over 2 weeks, Thanksgiving spread over 2 weeks. So if you eliminate those exclusions, because it's just the way the data is presented, the demand for the current year has been above the 5-year median for 15 through 19, which were 5 great years, which explains why the market is so hot. This now is looking at the days unsold inventory over time. I'm only looking at 3 components. I'm looking at the red line, Santa Clara County single family home, the brown line, San Mateo County single family home, and condos and townhouses, the yellow line in Santa Clara County. So you can see the dip down for Thanksgiving. You can see the dip down here for July the 4th. You can see the dip down here for Labor Day. That's just a holiday fluctuation. That's not changes in the marketplace. So basically, you can see Santa Clara County single family homes is on a downward trend. We're still going through the holiday shift, but I think you can sort of see this rolled over real recently. And so this downward trend is going to continue. If you look at San Mateo County, I'm not so sure that the downward trend is there. Long term, it was clearly there for all three of them, and it's clearly coming down here on the condos and townhouses, but San Mateo County looks more flat. Would I call that a different marketplace? No, I think it just hasn't caught up yet. I don't think it's worked through the holiday fluctuation. This is looking at a graphical representation of the days of unsold inventory. This is the single key indicator in my book. When you have numbers that are in the low teens, let alone single digit, the market is hot. So here we are in Cupertino, Sunnyvale with 6.4. It's saturated red because anything under 7 days is saturated red. I think before this year, I used to do something like anything below 22 and a half days was saturated red. We're so hot, I had to change my scale for single family homes. And then not far behind Cupertino and Sunnyvale is Milpitas, North Valley, Berryessa, Santa Teresa. As well, not far behind that, less than 11 days is Campbell, Cambrian, Willow Glen, and Santa Clara. So and then if you go up to San Mateo County, the Bay cities, Burlingame, San Mateo, those are down under 10 days. Foster City, very small area, so you really can't put much weight in that at 10. Redwood City at 14. Even the North San Mateo County area at 14. The only areas that had any significant days of unsold inventory are one, the coast, which tends to be slower, and two, the very expensive areas on the San Mateo, Santa Clara County border, like Atherton, Menlo Park, Woodside. This is looking at the frequency of overbidding. How common is overbidding? You can see we dipped down for the Thanksgiving holiday, which is fairly common. There's less competition, but you can see we're still at 75% or very close to 75% of all transactions in Santa Clara County, San Mateo County, single family homes, condos, and townhouses got more than their asking price. And again, that is not uniformly distributed. This is the frequency of overbidding. So you can see condos are lagging behind. They're somewhere around 67% of the sellers are getting more than their overbidding in Santa Clara County. Then you can come up to single family homes in Santa Clara County and you can see it's over 80%. San Mateo County is just under 80%. So when 8 out of 10 or 4 out of 5 of your sellers getting more than they're asking for price, you can clearly see the market's pretty hot. This is the frequency of overbidding in the different areas. Again, Cupertino, Sunnyvale is one of the hot spots with 92 days. San Mateo County North, that's San Bruno, Daly City, Pacifica. They're sitting at 93% of the sellers are getting more than their asking price. The lowest is right again on the San Mateo County, Santa Clara County coast border at 49 days. Moving on to see the magnitude of overbidding. This is what degree, how much above the asking price. The last one was how frequently. This is how much. And you can see we're somewhere right around 108.5% of the asking price on average. This is the distribution. You can see we go from a low of 101.5% up to a high of 17.8%, almost 118% in Cupertino. This is the overbidding that we already talked about. In general, as you go up diagonally and to the right, the market gets hotter. But again, for the last 22 weeks, there's just been a lot of bounce, a lot of fluctuation. The most recent week, this past week, is this purple line coming down through here. You can sort of see it's in the middle of the pack. In the middle, it's towards the upper end. At the top of the pack, that's just saying that some people are willing to overbid more. This is the last 12 weeks. The concept is the same, though. The dotted lines are the oldest 4 weeks, the dashed lines are the middle 4 weeks, and the solid lines are the most recent. So you can see out of the most recent, it's better than last week, which is sort of the burnt orange. It's about the same as 3 weeks ago, and it's significantly worse than 2 weeks ago. So that's just sort of, fluctuating, not really market shifting in one direction or another. This is the pricing of the different areas in a map form for you. And again, the same concept, the colors assigned by the median. So in Santa Clara County, the moderate priced areas being Campbell, Cambrian, Willow Glen, and Santa Clara, the median price is $1.75 million. The low end is essentially 1.3 million. The high end is 2.4, and you get an idea of what the prices you're going to expect to pay. This is the median sale price. Most people only follow the median price. As you can see, I try to follow the median price, which is the middle, 50%. I follow the top end, which I use the 90%. I know a lot of statisticians use the top quadrant, which would be 75%. I stretched it out to 10 and 90%. And the reason I did that is that 80% of the homes are between those two numbers. And that's pretty telling. If I use 25 and 75, then only 50% of the homes are between those two numbers. So I stretched it out a little bit. You can't go further than that because you get too much statistical bounce in something as unhomogeneous as real estate. This looks at some of the different components. So you can see inventory. Santa Clara County single family is the area that's missing the most, and we only have 42% of the inventory you'd expect. The area that has the most is San Mateo County condos and townhouses at 213%, double the inventory that you'd expect to have. The other two are, 3/4 for San Mateo County single family and 90% for Santa Clara County condos and townhouses. You can see how it changed from just last week. You can see the DUI, days of unsold inventory, varies from 13.8 up to 22.4. So they're all very hot marketplaces, but it does vary. It is interesting that San Mateo County's condos and townhouses are a hot marketplace on the rate of this marketplace when they have double the inventory you'd expect it to have. Frequency of overbidding, 62% to 81%. Magnitude of overbidding from 103 to 110%. And appreciation, there's a couple things that are noteworthy. First off, to have anywhere around 20% appreciation in the year is phenomenal. You can see earlier in the year, we were almost at 25% appreciation, but we dipped down, and now this, we went up, we hit for Santa Clara County single family homes, for example, we hit 24.8, then we dipped down to 16, and now we're improving slowly and we're back up to 21%. This will continue to go up. Next year, instead of comparing it to 2020 prices, I'll be comparing it to 2021 prices. So these numbers will not be as high going forward. And then this is the date when the old peak happened. The other thing that's really noteworthy, look at condos and townhouses in San Mateo County. They're actually 6% lower now than they were in 2020 after having shown 15.6, call it 16% appreciation. So there's been a 22% drop over, and this is based on 2020 prices. So it's not a 20% drop from the peak price, but from 2020 prices are down 20% from what they peaked out at. Here you can see the micro market areas. The yellow is where the peak price happened. So Santa Clara County, you can see the peak price was still way back in the rearview mirror, but all the sub micro market areas have had their peak price more recently. What does that tell you? That tells you that the market has been shifting. To get this kind of appreciation, you were selling more high end back then, which was back about the end of June, than you are now, because you're having higher prices overall in each one of the micro market areas, but the county number is lower. So South County's peak was back here on November 6th. These are their peak is the current week. So basically a good part of the center part of Silicon Valley's at their peak pricing now with 27% appreciation, which is just unbelievable. Cupertino, Sunnyvale was a little bit higher last week. And again, these are closings that happened during the last week. This column 2 weeks ago for this column, which means the offers were negotiated about 5 weeks before that. And then you can see the same down here in San Mateo County, the different prices. We peaked back here in June, we dropped down, and now we're going back up again. This shows you the breakdown of the different micro market areas. We talked about this graph earlier. So you can see the super hot days of unsold inventory. You can see that it does vary quite a bit, all the way from 6 up to 22. You go down to condos, it gets up to 24. The magnitude of overbidding changes from anywhere from call it 50% up to 88%. I'm seeing in Redwood City. Cupertino's at 92. So we're in the top half. Anything over 50, I consider to be a red hot seller's marketplace. The magnitude overbidding, how much overbidding are people paying? The low is at 1.5% above, and the high is probably Cupertino, Sunnyvale. Where is Cupertino? That's 17.8. I'm not seeing anything higher than that. And condos are quite a bit lower. On pricing in the single family homes, the redder the color, the hotter the market is, the bluer the color, the cooler, the lower the price of the marketplace is. In condos, I only go down, and it is noteworthy on how close these prices all are. The expensive areas, set the benchmark, I'll call that neutral at 1.3 million. But if you eliminate that, your condos go only from 760,000 to 970,000. They only have a swing of 230,000 $100,000. And that's why the colors are all very similar. And the low range is very similar. And the high range is pretty similar, except for the affordable areas. It peaks out at about 1.1 versus something closer to 1.3, 1.4, probably 1.4 for most of the other areas. This is showing December data, and it doesn't take a rocket scientist to say, how could I be showing December data when we're at the beginning of December? For 2021, I'm only showing data through the 11th, where all these other datas are through January the 4th, that gathered on the 5th of January. And the reason I show this is just so you can have some idea of where we stand, and you can sort of get a feel for what's going on. So if you look at the average days on the market, what's on the market really isn't that significant. The significant thing here is inventory, 314. That isn't quite the lowest. We had lower in 2017, but inventory is going to be dropping like a lead brick between now and the beginning of January. So there is no doubt in my mind, unless something major happens, this 314 will be way below 291, and we'll be setting a record low level of inventory this year. The square footage, you can see we're only at 1,900 square feet. Historically, we're probably somewhere closer to 2,200 in recent years. And that's basically indicating that larger homes were spending longer on the marketplace or making up a bigger part of the marketplace. If you get down to offers, you start finding out what's really going on with the current marketplace. Your average days is 19, and you look at that, and we've never been that fast. Now, I can't quite say at this time of the year because the data is really for January the 5th, and we're only at December. The median at 8, you're basically below any other records. So the market's been hot for a while. Days of unsold inventories at 13, that's the lowest number. Days of unsold inventory at 13, that's lower than it is. Median price at 14.98. 8.5, that's basically 1.5 million. That's the highest we've been. That's not the median sale price. That's the median price of what's been selling, their asking price. And we know that they're getting overbid. So when we get down to the median sale price, to find out it's higher than 1.5 is not going to be a surprise to anybody. And this data is not macro data, by the way. This data is single family homes in Santa Clara County only, which is what I followed historically the most closely. And I focus now on macro data because of the COVID. And I actually expected to be reporting bad news 18 months ago, almost 2 years ago when this thing started, but it's been basically a rosy picture ever since we were able to show properties. Number of offers accepted, you're basically at 800, and you can see that's pretty high number compared to where you expect to be. Jumping down to closings, the overbidding, 10% over, that's higher than it's ever been. And even if this number does go down, the highest overbidding I'm seeing is in 2018 at 109%. I don't think we're going to get that low. And we're at 81%. That's the year to watch, 18, which is, and that was January of 18. So that would have been December of 17. The 17 was a unique year. Not that this isn't a unique year. It was unique in the fact that we had 2 significant rounds of appreciation, one typically like we did in the first quarter, and then a second one in August. This year, we're starting to do that, but it was a much smaller round of appreciation, and it was also more subtle. In 2017, you basically had 15% appreciation, and then you almost had another 15%. When I say 15%, it was probably closer to 12.5%, followed by another 12.5%. This year, we had all 25% or close to it at the first of the quarter. We lost some of that, and now we gained most of the 25% back. So the appreciation in 2021 is very similar to what it was in 2017, but it just happened in a different form. You can see the sale price, the lowest now is at $1 million. The median is 1,660. This is getting pretty close to the record high. It's not quite there, as you can see. I think, and this is from memory without doing it, and I could go back and calculate it, I think we hit 1710 or 1720, and now we're at 1660, but that's still pretty impressive. And then the number of closings, this will drop significantly as we get further into the year. So the fact that you've had 900 last year, I'm not so sure which way over last year we will end up. I will actually think we'll end up a little bit lower, but that doesn't surprise me because last year we had a lot of extra supply so we could meet the demand and we could do everything. And this last slide I have not updated. It's still from October. I'll get to that for next week, most likely. And with that, I'm open for any questions that anybody has. And again, I'm going to point out that in 2022, you have to make two changes. One, the year changes to 2022, and the real REmarketGraphs is going to be abbreviated to REMG. I will try to set up both URLs initially just to not lose people, but hopefully you'll figure that out. Questions? Not hearing any questions. I will wrap it up and see everybody next week. Thanks for attending.